Happy Halloween, everyone. It's been a particularly spooky month for markets, and I've got a lot to say this week, so let's crack straight into it. So welcome to the Traders Circle weekly market update. Today is Tuesday, the 31st of October, 2023, and before I begin, you do need to be aware that anything I say is general advice only. So it doesn't consider your personal financial circumstances, and you have to decide if what I'm saying is appropriate for you. So let's start with the RBA rate rise. The RBA is pretty much almost guaranteed to raise interest rates next Tuesday at 2:30 p.m. when they meet for the November meeting. So they're likely to do a 0.25% rate rise, taking our cash rate to 4.35%. Now, in recent commentary, Governor Michelle Bullock did state that the RBA was worried about persistently high services inflation, inflation becoming entrenched, and she's referring to the recent CPI growth numbers that did show a bit of inflation in essential services, things like insurance and the like. Conveniently, though, she did ignore some recent inflationary pressures, such as oil prices, which have gone back up. Oil prices and associated costs are a big factor in our CPI growth data. She did ignore housing prices, housing costs, which were again another big factor in our CPI growth data. Both of those, I believe, more important than the issue of services inflation, and conveniently being ignored by the RBA because they know that lifting interest rates is unlikely, at least at this small amount, is unlikely to have too much of an effect on those prices. This goes back to what I've been saying a lot throughout all of this year, is they really should have gone a lot harder earlier to try and deal with inflation, and by dragging it out, they're basically making the situation worse than they otherwise would have been, basically. So we're going to get this rate rise. It's, I don't think going to have much of an influence over what our CPI growth does from here. I think it's, if they raise, it's not really going to decide whether our inflation goes up or down from here. That's more so going to come down to what oil prices do overseas. That's more so going to come down to what the global economy does. Maybe we'll see a little bit of strength in the Australian dollar if the Federal Reserve holds on Thursday and then we rise next week. But again, I'm not too sure if really the globe is going to pay too much attention to what happens with the RBA. So I think they've really mishandled this inflationary period. I think they should have gone harder earlier. I think the prolonged pause wasn't necessarily the message to send. And looking at the most recent inflationary data, they've not really focused on what's been causing our inflation. Instead, they've cherry-picked justification for doing another rate rise. And I don't think it's a particularly good look. Admittedly, it's been a very difficult period to be a central banker. But definitely haven't been instilling confidence into the market, and I think recent stock market weakness is really pointing to that. That rate rise has been a bit of a downwards pressure on markets, and that's been reflected as well in the bond market. So we've seen bonds fall off very strongly. We've seen bond yields rocket higher. Our government bond yield curve is basically the highest it's been this decade. We've got our 10-year approaching 5% yields, and just absolutely extreme levels, really, especially given the level of private debt in Australia. So 5% across 10 years, that's absolutely a very high level. That's the market sort of saying we think interest rates are going to be very high for quite a long time. We do have a slight inversion in the shorter term, but we're not as heavily inverted as US markets. It does still point to a bit of an economic slowdown in the next year or two, though, potentially a recessionary indicator for Australia in the next sort of 12 to 24 months. Overall, our bond yields pushing up is the market basically adjusting to an expected higher for longer period for interest rates. And indeed, the RBA themselves have been pushing out their expected rate cut timetable towards right at the end of 2024 now, and perhaps even into 2025. Again, though, the RBA has historically been terrible at predicting future interest rates, so whether that can be relied upon or not is very difficult to say. Finally, we'll once again touch on the conflicts going on around the world, and specifically, obviously, the Israel-Palestine situation. We did see Israel move into Gaza They already were sort of invading Gaza in a sort of piecemeal way, but they sort of did a more broad-based invasion over the weekend. That was largely preempted by US shares on Friday, and they sold down based on, the invasion expected to happen over the weekend. Though the invasion happened, it was at a slower and more perhaps careful pace than US shares initially expected. And in addition to that, Iranian-backed militias and Iran's allies didn't join the conflict as dramatically as perhaps some had expected. And so with the conflict maybe escalating less than expected over the weekend, despite the invasion, US shares did regain a bit of ground on Monday night. There's pretty much a total blackout on news and anything coming out of Gaza, so we don't really know the situation on the ground there, but I think markets are a little bit enthused that the conflict doesn't seem to be spreading to other nations too severely just yet. Obviously there's still plenty of attacks from Hezbollah up north, from Lebanon, but there haven't really been any sort of escalations in terms of attacks from Syria, Lebanon, or other Iranian-backed groups. So hopefully, we can find some sort of resolution here, some sort of peaceful resolution in the short term. Doesn't look like that's going to be the case, but in the absence of that, hopefully we don't see any further escalation. And like I said, I think the markets in the US were a little bit enthused that the conflict hasn't really spread to other nations just yet. So let's have a look at the charts for this week. For our own market, we've really been on a very severe downwards move. We're now more than 10% off our yearly peak. We've met the mark for a technical correction. We've found fresh yearly lows. We're back towards the levels not seen since roughly this time last year. And we're actually below the levels we were at before the COVID selling. So if you go back and take the chart back to 2022, we're below where we were pre-COVID. So all that money printing, all that inflation doesn't seem to have pushed the Australian share market any higher. We're well below those levels. In terms of potential support levels, we could be forming up a bit of support, maybe around 67.75, 67.80, which is roughly the lows of the past few days. It's also the lower bound of my descending channel here. Should we bounce up, I could see a move back to 6,900, although it's hard to see us going too far beyond that level until we see some, positive news, some positive fundamentals for our market. I was sort of saying in my webcast today that currently our market's extremely negative because the narrative is that we've got a rate rise coming. The narrative is that on Tuesday next week, the RBA is going to lift interest rates again, and obviously our market's adjusting for that at the moment. So with that negative news ahead, it's very hard for us to see significant gains. However, on that news, when we get the rate rise and moving after that rate rise, the narrative will change. And it could change to, again, that we're now at peak rates, that the next move might be lower. And so, although we're falling into the lead up to the rate rise, that rate rise might be the piece of news that turns our market back around. Too early to say. We'll have to wait and see what happens on Tuesday next week. Looking at the US market, they've also been on a bit of a sell-off. They're also 10% below their yearly peak now. So they've also made a technical correction. They've broken their yearly long uptrend, broken below the 200-day moving average, and they've fallen back to the 4,100 point level, which was their support through May of this year. They did bounce a bit overnight, and to me they technically look a little bit bullish now, up to say 4,200, 4,220. They are still setting lower peaks and troughs though, so over a more medium-term period, they remain looking negative. For their market, the key things to watch this week will be their Fed meeting, which will be on Thursday night Australian time, and then their unemployment data on Friday night. It's hard to see those events shifting this current bearish move. The Fed's unlikely to raise rates. Unemployment is likely to be roughly what it was last time around. So there'd have to be some sort of unexpected event that shifts things. One potential sort of unexpected event will be European CPI tonight. European CPI has actually been starting to come down back towards roughly, the Australian target range of, upper bound of 3%. Still going to be above that, but it is headed in the right direction. We saw German CPI overnight, Spanish CPI, both better than expected. So that could be a potential bullish catalyst for shares if European CPI continues to come down. Alright, I will end it there for this week. Overall markets aren't looking very good at all. Our market, obviously, very little confidence in the RBA and expecting another rate rise next Tuesday. And looking a bit oversold in the short term. So hopefully you guys enjoyed this one. If you did, click the like button. If you didn't, I assume you're an RBA fan and I don't mind. I'll see you guys next time. Bye for now.